All right. Hey, what's going on, everybody? So thanks for joining in. So today, well, I guess before talking about exactly what we're doing today, first just a quick intro for what this is. So I call this the Sprint Review. Basically, I just do a every other week live stream to talk about something that's related to personal finance for tech professionals, right? And so quick intro for me is my name is Mike Zung. I am a certified financial planner, and I am the founder of a fee-only firm called Java Wealth. I'm based in Kansas City, but I work with people virtually all over the country. And then also I used to be in tech, so that's I kind of have a little bit of that. I have my MongoDB T-shirt, my swag, so I'm trying to get a little street cred there. So anyway, I'm super excited about the topic that we are going to be talking about today. And so what we're going to be talking about is everything around your company going public, so around an IPO. So I say what to expect when you're expecting your company IPO. And so yeah, and really, so we'll kind of start not just the IPO coming up, but like as soon as you first hear about it, and we'll just be kind of walking through some of that stuff. And with me today, I'm super excited about this, is that I have Daniel Zajac. He's what we call the OG equity comp blogger. So he has a really amazing blog with a lot of really good information, and it's all really focused around the equity compensation. So I was super thrilled to be able to have him come on, and I don't know if there's anyone that's much better about talking about this than he is. And so without further ado, I'll invite him up onto the virtual stage. So Daniel, how's it going?
Hey, Mike, thanks for having me and for the nice introduction. Too kind. I appreciate it.
Yep. Yeah. So I guess first, before we get started, so just give everybody a quick overview of who you are, where you're located, and all that good stuff.
Yeah, sure. So as Mike said, I'm Daniel Zajac. I'm managing partner of the Zajac Group. We are a financial planning and wealth management firm located in Philadelphia. Like you, Mike, we've worked with clients all over the country. So just brief history. I started in this business about 18 years ago in a firm that was founded by CPAs and CFPs. And about 8 or 9 years ago, had a client who had some equity. Quickly realized there wasn't a ton of advisors in this space, right? And dove in, right? So, fast forward 8 years, coinciding with writing, and basically people find us on Google now, right? That's where they search, that's what they find, and they reach out, and we help clients with equity.
Right. Yep. Yeah. That's and it's a similar kind of thing that once. So in starting with this, I didn't really focus just on the equity compensation part of it. But yeah, once you start working with people and you see the issues that come up that are more specific to equity compensation, that you see that there is so much more, there's so much more going on than just your normal of like, hey, you should budget and open up a Roth IRA and all that kind of stuff, right?
Yeah, it's before niching, so to say, I was like the anti-niche, right?
Yeah.
And I kind of stumbled in this, right? And I didn't believe it was a thing, right? And then I had the client, started writing, and just by circumstance fell into the niche. And obviously now I'm in the camp of, yeah, this is a no-brainer. This is great, right? Let's keep doing this. Because to your point, there's so many moving parts, especially with equity, that it just, the more of it you can do, the better you're going to get at it, right?
Yeah. Yep. Yeah, and it definitely keeps it interesting. I mean, as far as just because as long as you have that equity, then that company stock isn't staying put, and so the decisions can change pretty quickly.
Yeah, decisions can change, and it's it still is financial planning, right? At the end of the day, what we're doing with our clients, and I'm sure you're doing with your clients, it's financial planning.
Yep.
What are we trying to achieve? What are our goals? What are our objectives? Risk tolerance, all those things. But the difference is we're just overlaying this concept of equity comp, right? Whether it's the behavioral side or whether it's the technical side, how do we overlay this need on top of the rest of the financial planning part?
Right. Yep.
Right?
Yeah.
How do we integrate the two?
Yep. Yep. Yeah. And even we're just going on a complete different tangent right now. But but yeah. And then I think that, and then another thing that I like about it is that, the equity comp part is the technical part of it, but then what you were saying of like the more personal side of it of, what's actually going on in someone's life, that there can be two people that have the exact same equity comp package, going through the exact same IPO, but then their plans are wildly different, just based on
Sure.
all of the other factors, right?
Yeah, I mean, it's whether they're 25 or 30 and just getting started, or this is enough to get to retirement, right? I mean, the
Right,
conversations could be wildly different, right? And
right,
then the actions that these clients are taking could be wildly different too, right?
right,
Because one might be risk on and one might be risk off, right? And that's the fun part, right? That's the best part of the job is talking through those conversations.
right. Yep, yep, yeah, exactly. So and actually, so you said that you started with, it's a firm of CPAs and CFPs, and I see that you have your EA too. So actually, so when did you get your EA? When did you start doing the, like, focusing on the tax side of it?
Yeah, it's always been in the DNA of the firm, I think,
Yeah.
to have the tax side because of the CPA. So, we learned so much about it, and then it just became. I think I've had it now. Gosh, I don't even know, maybe 6 or 7 years.
Uh-huh.
I see more and more people getting it now, which is great. Um, but I probably had it 6 or 7 years, and honestly, I just had it just to get right now. I can officially sign tax returns if we're doing them, or
Right.
just for the extra knowledge. It's a good to have, right?
Yep.
So, and then particularly in this space, right? Now, I don't
Yeah.
think the EA focused too much on this space, but understanding the tax implications of your decisions is important, right?
Right.
So it's a good to have.
Yep. Yep. Yeah. Exactly. Cool. All right. Cool. So actually, before we get started into any, the meat of this topic, I have the special privilege of talking disclaimers. So first, before just a disclaimer on this video is that, so this is just general explanation educations, not specific tax, legal, or investment advice. And before considering acting on any of that, first consult with your own legal, tax, or investment advisor. And exactly like what we said, it's all personalized. The answer for you is going to be personal anyway, right? Um, and then also just to beat you over the head with different disclaimers. So then there's also the one for Daniel's group. So securities and advisory services offered through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor, and fixed insurance products and services offered through Zajac Group or CES Insurance Agency, and tax preparation services offered through Zajac Group are separate and unrelated to Commonwealth. Okay, I'm gonna have a moonlighting gig and voiceovers for doing disclaimer stuff.
You did a good job. Compliance will be happy with you.
Yeah, that's right. Yep. All right. So now we can talk about whatever we want. No. Yep. So okay. So today, we're talking about just everything that goes on with your company going public, right? So first, let's go ahead and start at the beginning of just you're working for a private company and you find out that you're going to go public. So I guess maybe I'll just leave it open for you as far as, so whenever someone comes to you and they say this is happening, then kind of where do we start with this?
Yeah, it's my brain actually goes even before that, right? Because
Mm,
there's potentially stages even before, hey, we hear about we're going public or the rumors are starting, right?
right.
So the first question is, where are we in the process? How early are we, or are we close to that IPO point? Um, but yeah, eventually clients are going to reach out and say, hey, I think we're going public, right?
Right.
I think that it's happening, or I hear we filed an S1, or
Yep.
it starts almost as like I don't say the rumor mill, but it starts with like a lot of questions about more what's going on,
Right.
right? Um, and that is often an actionable time for a client, right?
Right.
Until this point, a lot of times it's kind of a hurry up and wait, right? We're just waiting, we can't do anything anyway. So, that's way over here. We're not even going to touch it,
Right.
right? And now the possibility of going public is there, and now it's what do I need to do? What do I need to do to prep
Right.
pre-IPO, and what do I need to do to prep post IPO, and all of the questions start firing.
Right, right. Yep, yep. Yeah, and so I guess and we won't go into all the details of like what an S1 is or anything like that, but it does feel like whenever you hear that the company has filed their S1, that it's like it definitely becomes more real because that is a step that has to happen before you actually do go public, right?
Yeah, and I think that's the time that it's what should I be doing now, right?
Right,
If anything, right?
right,
Should I be exercising before the IPO, and what is the implication of that? And that's really, I think, a big common question. What do I need to be doing before the IPO, if anything, right? If
right.
anything, and then what do I need to be aware of after that?
Yep, yep. Okay. Yeah. So I guess as far as like with that lead up, so one thing that I was kind of thinking about was, knowing what the rules of engagement are for whenever you are going to go public. So there's three main, there's three main classes of going public right now, right? So there's like the classic IPO, and then you can do a direct listing, or you go IPO via a SPAC, right? And again, we won't go into all the nitty-gritty details of that, but I can toss it over to you, or either one. You want to take this, or you want me to?
Yeah, I think that for us, what we see most of is still just a traditional IPO,
Yeah,
right? So, a lot of times in these traditional IPOs, there's notification, and then there's a day, right, where there's a day where your company finally goes public, and there's huge
right.
excitement, and everybody's super thrilled about what's happening,
Mm-hmm.
and the reality though is for a lot of these IPOs, that doesn't necessarily mean that the client can sell right away either, right? Because with a lot of
Right,
these IPOs, there's post IPO lockups, there's blackouts, and there's all these other technical things that need to be uh, taken into consideration. So
right,
while you have now a liquid company and a stock price that's moving up and down, it's still you might still be locked up, right?
right.
Which I don't know if that's better or worse for the client, but a lot of times it's interesting to see how that all plays out,
Right. Yeah. So
right? And
it's like
then
there's this party or there's this rave going on, and you're on the outside and you're just looking through this window. It's like, whoa, look at all that stuff going on.
yeah, exactly. Now, when we talked prior, you mentioned that some of your experiences with the direct listing side. So
Uh-huh.
so take me through that a little bit.
Yeah, so yeah, so I've had a handful of clients that they've gone public, and their company goes public through a direct listing. And so I guess maybe just a little bit of the technical details is that it's like, they're not going through an investment bank to to facilitate their company going public, and they're not necessarily trying to raise any more money. And so it's basically just that company is saying, okay, we are public now, and we're doing it ourselves, and so the shares just become available. And the main thing to take away from hearing if your company's going like public via direct listing is that there is no lockup. Like it's like, I mean, it can make for a wild I guess you don't call it an IPO day, but like a wild debut day, where because as soon as you debut, it's like noon or 1 o'clock, and you're not locked up or anything, and you can just sell it all or anything, and it's definitely an emotional experience for the people going through it.
Yeah, but if you just compare and contrast the two, again, they're probably wildly different, right? In
Hmm.
one, in your world, in the direct listing, yeah, it's like, okay, that happens, and I have liquidity now, assuming where there's no
Right,
blackouts or anything like that. Like I have liquidity, and I can do potentially whatever I want, obviously subject to
right,
rules. But with the IPO, with the traditional, we'll say 6 month lockup, if that's what it is, like you said, it's there's the party, but I'm still on the outside, right? So
right.
it wildly different experience, I think, for the client.
Right. Yep. Yep. Yeah. So I guess yeah, that's the main one from a direct listing perspective. And then the last one, and we won't go into all the details because every one is completely different. Is this idea of going public via SPAC, right? So my
Yeah.
understanding, and I guess full transparency, I have not worked with anybody directly that has gone public via SPAC, right? But so my understanding is that it's basically there's just with the nature of how they work, is that there's going to be there can be a lot more kind of like specific rules or funny rules of like the how much you can sell, and just kind of some of the ins and outs of it.
Yeah, it's whenever we're working with our clients and we're talking about going public or debuting, direct listing, IPO, SPAC, we're always asking questions, right? Hey, can you find out about this, or can you find
Right.
out about that? And in my experience, we've often had to ask a lot more questions when we've been going down the SPAC route, right?
Right.
So we get the information we need. It just seems to be, and again, this is a limited experience, but
Mm-hmm.
there was just a lot more questions that we were asking, right? Which is fine. That's part of our job, is to work with the clients to get the information we need to help them make good decisions.
Right.
Um, so yes, I think that each one is probably a little bit different, and
Right. Yeah. Yeah.
yeah,
I mean, basically the overarching message with all of this is that even if you know which way it is, the main thing is to be asking the questions of what are the rules of engagement for us going public. Asking those questions of your company, and yeah, attend their informational meetings that they have, because they'll tell you a lot of that stuff, right?
yeah, and it's attend the informational meetings, ask a lot of questions, and don't be afraid to ask questions, right? You
Right.
should be asking questions to get clarity, and if you're not getting clarity, continue to ask questions, right? Because
Right.
that's okay, and because each company has their own nuances, right?
Right.
And oftentimes you'll find an employee who's really motivated and willing to ask a lot of questions, and
Right.
you can use that to, get information, which is great, right? The one thing we didn't touch on with the traditional IPO is also the concept of like an early lockup release, right?
Oh, yeah.
So
Yeah.
with a direct listing, a lot of times, like you said, you debut, and now there's liquidity. You can sell your shares. And I talked about an IPO with a traditional 6-month lockup, where it's, hey, you can't sell these till the end of this period.
Right.
Sometimes we've seen companies that will say, okay, on or around IPO day, or on or after IPO day, for a certain amount of time, we'll allow you to sell some portion of your stock, right?
Right.
And then after this kind of short-term window closes, we're gonna lock you out for the next 6 months. But it's something I've seen that allows liquidity
Right.
in the short term for some of these clients, right? Which could be a really good thing, right? If somebody's looking to get out sooner rather than later, definitely something to look into and to explore.
Right. Yep. Yep. Yeah. So I'm just going to keep beating this analogy of like there's this party. So what we're talking about here is that on IPO day they actually let you in for a little bit. You can have a drink, dance for a
Yeah,
little bit. Then you got to get out.
yeah. We'll see you in 6 months.
Right.
And you actually have to stare through the window for the
Right.
next 6 months, right?
Yeah, yeah, yep. And that version of that is just getting on your phone and just watching the stock price, move around the entire time.
Yep, that's exactly right. So it's we see it, as you know, right, from our side, right? But to
Right,
be in the driver's seat, to be these employees, is something we can experience, but
right,
we can't share that with them, right? That's
right,
theirs. That's their emotion. That's their experience.
right,
And as the advisor, we can, I've seen it a lot of times, right? But I've never been through an IPO personally, so I can't be in that exact seat.
right, right. Yep. Yeah,
Yeah.
yeah. So actually, let's talk about that a little bit, just from that emotional perspective of it. Um, let's see. I'm trying to figure out like where to exactly start with this. But yeah, so I guess really first it's just, yeah, like what you're saying. We can try to empathize as much as possible with the feelings that they're going through. But I mean, it's definitely something where these events are, they're potential windfall events for people, right? So it's a
Sure.
potentially life-changing thing to go from basically having some amount of money to, like, I mean, it could be 6-7 figures of a change in a day, right? And
8
so
figures.
8 figures, yeah, yeah, exactly.
Yeah.
And so I guess what are maybe from your experience, like what are some of the things that I mean, like what do you talk to people about with this?
Yeah, we talk about that, right? I think we talk
Right,
about that. I think that again, putting yourself in that seat. So now we have to, on one side, talk about all this technical stuff. We need to talk
Mm-hmm.
about, AMT and holding periods and blackouts and lockups and direct listing, or, everything we're kind of touching on already, which is great, right? But I don't want to say that's the easy stuff, but that could be learned, right? That's the stuff that me and you do behind the scenes, right?
Right.
That's the stuff we're looking at. But then you have this emotion of somebody who, may or may not have experience in finance or markets, or this is likely the first time they're IPOing, right? So, and now they need to make really big decisions of really significant amounts of money,
Right.
maybe in a short period of time, right? So it's just helping facilitate that conversation, right?
Right.
And helping them to understand that, yeah, that's the decisions that we need to make, and here's the pros and here's the cons and here's the whys and the why nots. And I can speak anecdotally from experience with my clients, but it's emotional, right? And getting
Right.
back to what we talked about earlier, it's emotion that's different for everybody. It's different for a 25 or 30-year-old
Right.
than it is for a 55 or 60-year-old, right? Or it might be different for someone who has, 8 figures versus somebody who has 7 or 6, right?
Right.
It might be different because the way they look at the world. There's a million reasons it's different, but it's different for everybody.
Right, right. Yep. Yeah, and I guess one of the main things that I've found just from that emotional perspective, because yes, I mean we haven't really touched on this too much, but whenever the company goes public, the stock is generally pretty volatile, right? So
Mm-hmm.
so there's going to be a lot of ups and downs, and so your emotions can essentially ride those ups and downs too, right?
Yes.
Um,
Yeah. And
yeah. So
go
and
ahead.
then yeah, really, I was just thinking that from what I've seen, is that no matter like and maybe this is a shameless plug for basically, hey, talk to somebody, talk through this stuff with somebody, right? Is that having a plan, having something in place, that it's like, okay, this is what we are going to do to try to, I mean, you obviously can't completely take the emotions out of this whole process because of
Sure.
just the nature of what's going on. But if you have something written down and say, okay, this is what we're going to do on IPO day, and this is what we're going to do 6 months later, and all that other kind of stuff, and you have it written down, that it's much easier to kind of be at peace with what actually happens during that time. Like you're not kicking yourself of just like, oh, I should have done X instead of Y, right?
Yeah. Yeah. It's so to add on to, I think what you're saying is, hey, let's have a plan today because this is how you feel today.
Right.
And I'm going to remind you of this in 6 months, right? I'm going to
Right.
remind you this is the way you felt 6 months ago. And we're going to look back at this, and yeah, it could change, right? It's a plan, it could change, of course,
Right.
but we need to have a benchmark, and that's a good way to look at it, to say, hey, this is what we did talk about 6 months ago at IPO, and this is the plan then. And yes, it might be volatile since then. It could be up, it could be down, but this was the plan. So
Right.
there was some logic to this. Do we want to go back to this? I
Right.
think getting back to the emotion, I mean, we often talk about a couple things with clients. One, FOMO, right? The fear of missing out,
Right.
right?
Yep.
Missing out. The reality is on the upside, but also on the downside too,
Right.
right? That it could go both ways. So that's a conversation we like to have with clients. Um, but then just I think there's a fear of maybe making a mistake too, right? Not being sure
Right.
exactly what to do. So, and those are strong emotions, right? Missing out, making a mistake. So again, the more you're talking, I mean, the better decision making you're going to make, hopefully, right? I mean,
Right.
has that been your experience?
Oh yeah, yeah, definitely. Yeah, that it's talking through that stuff, and then so that whenever, especially I'm thinking of some of the clients that had the direct listing stuff, where like because I'm pretty sure they had some coworkers that are just watching it every day and be like, oh, should I do this now? Oh wait, no, I think I'll wait for a little bit. Wait, now tomorrow should I do this?
Yeah.
And so, but like for me, the thinking of what the goal is be like, okay, we want to be able to talk through this so that whenever this day comes, this IPO day comes, like that you just relax, you drink a lot of water, you go for a run, and like the plan just executes, right?
Yes. Yeah. And everything you're saying, right? I agree. One of the difficult parts, I think, for the client becomes actually maybe pushing a button to sell, right?
Yeah.
Because that's something that would need to be done by them, right?
Yep.
So again, probably first time maybe doing this, unique experience, big numbers. So now you get into maybe a period where it's, hey, we have 2 weeks,
Mm-hmm.
you know, today, tomorrow, the next day, like, and then it gets into this again, just, process of when, like how, why. And
Right.
it's, so yes, we're talking globally, but there's also like a micro process here too
Right.
that needs to be taken care of. So it's really interesting.
Yeah, yeah, definitely the actual pushing of the buttons and the execution of that stuff, that can definitely be nerve-wracking, right? I know, I have had some experience where you can essentially put in your orders the day before, right? So
Mm-hmm.
that it's like, okay, you can kind of do it while you're not watching the stock like move in
Yeah.
the screen right next to you. Yeah, so there's that, but I mean, yeah, it's definitely something where yeah, like just the actual execution of it, like it can feel just really daunting just from because
Sure.
you're literally, you're following through with it, and it's the literal actions that are making the money come to life, right?
Yes, and as you said, if it is volatile, I'm not saying it will or won't be, but if it is, then too, just, I mean, it could be up and down in the day, let alone the
Right,
week, right? So, quote unquote, finding the right time. Big picture, it might make sense. Yeah, we agree to sell, no problem, whatever the
right,
reason is. But then the micro action is
right.
a subset of that, right? It's
Yep.
really, it's it's a lot, right? It's a lot. Exciting, it's great, right? In theory, you're doing this because you're able to buy something for maybe pennies on the dollar and it's way up here,
Right,
but that still takes a lot, right?
right, right.
Yeah.
Yep, yep, yeah, very good. Let's see. So I guess we talked about some of the lead up stuff, and I figure we won't go into all the details of like how the logic of how much should you exercise beforehand, because honestly I don't know, like there's no real great rules of thumb for it. Um,
Yeah.
yeah, I mean maybe the only one that I can think of is, especially whenever you talk about like the 6 month lockup period, is that there's some of this logic, and I think Wealthfront has a really good article that kind of talks about timing of when you exercise stuff leading up to an IPO. Is that this idea of potential, looking at, consider exercising 6 months before the IPO date, so that there's you start the clock, then it IPOs, and then 6 months later, whenever you're able to sell it, then you've reached that long-term treatment. Right.
Yeah. Yeah. Particularly for ISOs, right? So we're talking
Right.
about ISOs
Yeah.
in the
Yep.
qualified period, right? Yeah. So yeah, there's a timing issue. So if you do exercise post IPO, so to say, with ISOs, and you want to get long-term capital gains, again, not saying it's right or wrong, but it's yeah, now even if the lockup ends 6 months later, you're not selling at that point if you want
Right.
to get qualified sale, right? You got to wait now
Right.
6 months beyond that, 6 months and a day beyond that. So yeah, some pre-planning is certainly warranted if you can, right?
Right.
And that gets into, what's the 409A, what's the spread, before pre-IPO,
Right.
understanding some of those numbers to figure out what makes sense,
Right.
right? But at the end of the day, there's risk there too, because if you do
Right.
exercise, there's no certainty of IPO, right?
Right.
So you have to understand that too.
Yep. Yeah. Exactly. Yeah. It's like there's a better chance that it's going to go public, but it could still fall through, right? And then it's like, okay, well
Yeah.
now I just have these exercise shares. I can't liquidate it at all, and maybe I actually kicked in AMT, and I don't have I have to find other money to pay that AMT bill.
Yes, yes. Because so now you're paying for the shares, you have to buy them, and now there's potentially AMT if you have the cash or not, right? So there's a lot of planning
Yep.
that goes on there.
Yep.
And
Yep.
calendar year matters too, right? Is it beginning of the calendar year? Is it the end of the calendar year? How's that going to impact cash flows? So,
Right.
yeah, definitely a lot of nuance there.
Right. Yep. Yeah. So if you've tuned in expecting answers, then I think we've given you more questions than answers. So yeah.
That's all right, right? That's part of our job.
Yeah, exactly. Yep.
It's funny. That's actually what I tell clients all the time. I say, listen, I'm going to be your blind spot, right? Like, what are we
Right.
thinking about that you may not be, right? Here's
Right.
all the things you can get on the internet that are obvious, but what are we thinking about that you're not seeing?
Yeah. Yeah. That's a really good way of putting it, because I have had people say, I mean, you'll hear people say, I just don't know what I don't know. Right. And
Yeah.
so like that's what I'm looking for. And so that's exactly what you're saying, where it's just like, yeah, like, have you thought about this? It's basically, I think I think there's the bias, especially of the company that you work for, that everything's up and to the right. It's like, oh yeah, the
Mhm.
stock's going to go up, right? And so you
Yeah.
kind of plan accordingly, where it's like, ooh, if I make this move here, and then whenever it IPOs, and then 6 months later, it's going to be higher, and I get long-term capital gains on all this stuff. Like, yeah, maybe.
Maybe, exactly.
Right.
Yeah, maybe. And it's funny because you have clients come in and say, I don't know what I don't know. And then you have clients who have a little bit of working knowledge, right?
Hmm.
And, so even the client, where they're coming from on their knowledge level is really, really interesting.
Right.
And then you have other clients say, listen, I don't know anything. That's why I'm here, right? Help me
Right.
understand. So it really, it does run the gamut in terms
Right.
of what they're looking for.
Right. Yep. Yep. Cool. Yeah, cool. So let's see. So we kind of talked leading up, kind of talked a little bit more about the emotions of IPO day, and then maybe just a little bit of just talking a little bit from we said the lockup, but then also maybe if you want to go into a little bit of blackout periods, because that's something that for someone that's
Yeah.
going public for the first time is like, okay, what is this?
Yeah.
Can
What is
I,
this thing?
otherwise can I just go, right?
Yeah. Yeah. So let's take the traditional IPO with the 6-month lockup, right? So company goes IPO January 1, potentially you can't do anything for the next 6 months. Again, check your plan document, check your rules, right? So,
Right.
you have the first 6 months of the year where the company is going up and down and left and right. And then you get to the end of the 6-month period and finally your company says, okay, Mike, now you're good to go. You can sell, right?
Right.
So you feel great, right? Okay, cool. I'm free and clear. Um, but then what happens is that might only be an open window for 30 days, where they might say, hey, you can only sell for
Right.
30 days. And then we're going to put you in what's called a blackout period, right? And a blackout period basically says, hey, during this time, you're not allowed to sell, right? And I've seen, I don't want to say it's not uncommon, but I've seen this where an open window might last a month and then you're blacked
Right.
out 2 months.
Right.
And then a
Yep.
month open, and it typically corresponds with earnings season and stuff like that. So,
Right.
um, but it's not this totally carte blanche, assuming you're an employee and subject to these blackouts, period, where
Right.
you can just do whatever you want, right? There's still going to be these times where you can sell and then you can't, and then you can sell and then you can't.
Right.
So understanding that cadence is important because the stock price is going to move again during all this
Right.
time. So if there's only a month to sell, you might need to act during that month,
Mm-hmm. Yeah. Yep.
right? So, and then it gets into uh, when do you exercise, right? Do you exercise or can you exercise in a closed period or an open period and then match that up with when you could sell to reach qualified? There's kind of a
Right.
lot of planning around that as well.
Right. Yeah. Yeah. Actually, I mean, so this is just now I'm someone in the audience now asking questions. So from like for the blackout periods, do you find that like people are also locked out from exercising inside those
Yeah,
those periods too?
I would say check your company. Just
Right.
ask the
Yeah.
questions. Yep. I mean, I'm not trying to be, but that's what we're always like. Hey, can you do this? Ask your company, get
Right.
clarification.
Right.
Go ahead.
Right.
Right. Yeah.
That's a good answer. That's a better answer than I would have given. Yeah.
And I mean, there's these public companies have departments that are made for this, right? To
Right.
help answer these questions because no
Right.
one wants to get themselves, doing something they shouldn't be doing, right? So
Right.
it's, just always check. And
Yep.
I'm sure you're relying on that information with your clients as well, right?
Right. Yeah. Yep.
Yeah, definitely.
Yeah, exactly. Yeah, and just maybe just a quick explanation for just the logic behind having these blackout periods. Essentially, it's your company that is trying to protect you from running afoul from possibly being thought of having insider knowledge, and so from like insider trading type stuff. And so that's why those trading windows will be around the earnings calls, because the general idea is that okay, you have your earnings call, and so your company has kind of opened their books to everybody to say this is how this last quarter's gone, and so now that everybody knows, we're all on equal footing, and so during that open during that trading window is like, okay, now you can do stuff, but then it'll close for until the next time. Right.
Yeah, and then for certain employees, I don't think we need to go too far into the weeds here,
Right.
but you may need like a pre-clearance to make a trade, or there's things like 10b5-1 plans,
Yep.
which again aren't necessarily conversation for today, I don't think, but
Right.
basically where you put in your plans for the next 6 months or a year during an open window, and it executes that plan for you over time.
Right. Right. Yep. Yeah. And
Yeah.
so, yeah, with that, it's almost 10b5-1s are almost like nice in that it's forcing you to, it's like, hey, you have to plan for this. Like you have no choice
Yeah.
but to plan out the next 6 months or something. Right.
And it gets back to what we were talking about having that plan on day one that we're going to have and then remind you of 6 months later,
Mm-hmm.
right? To look
Right.
back at. But we have a choice now with a 10b5-1
Right.
plan. There might not be a choice, right?
Right.
So
Yep.
it's same logic, right? Put a plan in place and let's follow through. One might be, you might have the ability to change. The other one you might not.
Right. Right.
Yeah.
Yep. Yeah, very cool.
No.
So I guess maybe just to finish to put a bow around this part of it is that just I guess what are some of the considerations that you think that you talk with clients through whenever it's like what should I do for this IPO? Right.
Yeah. So a lot, I guess, right? But
Right.
I want to touch on one thing before I answer that. And then we circle
Okay.
back to that. But often after we talked about like 6 months and then lockups and I think we talk about emotion a lot too. So what
Mm-hmm.
I've seen more anecdotally too is you have this major excitement during an IPO, and then as time goes on from the IPO, and you've been public longer, the emotion starts to settle, right? Just like
Yeah.
anything, it starts to settle,
Yep.
and each open window, you've probably possibly seen some volatility now. You've seen it go high, you've seen it low. So I think the excitement still starts to wane a little bit, and there's maybe I don't want to say more clarity, but like decisions might be easier to make as time goes along as you expand on from IPO.
Right. Right.
Right. So, and again, that's I don't know if there's anything really valuable there other than just be mindful of that, right?
Right. Right. Yeah.
Yeah.
That
So
you're not on a crazy roller coaster the entire time.
yeah, or you can handle it better, right? Maybe
Right.
it's
Yeah,
that,
that's
right?
your
Maybe it's just the emotion.
you learn to love it. But yeah,
Exactly. Exactly.
yep.
So, and then back to your question. So, what are we planning for leading up to an IPO or an IPO?
Hmm.
Um, I think a new client comes to us. It really is just about documentation. Like, let's get everything we can so we know what the rules are,
Right.
what stocks you have, what options you have, what exercise history you have. Uh, do you have ISOs? Do you have non-qualified? Do you have double trigger restricted? Like, what do you have, right?
Right.
Because I think, I'm sure in your conversation with clients, it's you hear one thing and then you see documents and it's part of
Right.
that, but then you also see other things, right?
Right.
So
Yeah. Yeah.
just getting documents, understanding what the client wants to do, right? The
Right.
whole personal side of financial planning,
Right.
right? Um, and then really just about carving out a plan. Do we want to do anything 6 months pre-IPO like you touched on? Are we willing to assume that risk? Can we handle the cash flow? What does that look like? What is our plan on IPO day if there's an early lockup release? Um, what is tax implication?
Right.
What are the tax implications? What does that look like? How do we plan for that? Are they going to withhold? Are they not? It really is just taking all that into consideration. Do you have an ESPP? That's a big one, right? Is your
Oh
company going to
yeah.
offer an ESPP with like a look back and a discount?
Right.
You have all this stock here already. Do you want to participate more?
Right.
And what does that look like from a cash flow standpoint?
Right.
So there's just a lot of planning that goes into it, But I think a big common one with ISOs in particular is, do we exercise any now? Presumably with a 409A that might be lower than an IPO price.
Right.
If that's the case, what does it look like? Do we want to do that?
Right. Right. Yep.
Yeah.
Yep. Yeah. Yeah. So I guess yeah. In closing, there's a lot to think about, right?
There's a lot to think about. There's a lot to think about. No perfect answer today, is there?
Right. No, and I mean, but that's the thing, like, and for, like I was saying, it's one thing that I feel like, especially with people in tech, like and I was talking with Meg Bartelt in the last one about this, that it's like people want to always just optimize to be like, I am going to do this thing and it is going to be the most optimal thing from a tax perspective or whatever, right? But I think part of this is just giving someone permission to be like, hey, I need, whether it's like I need this money now because me and my spouse are wanting to buy a new home, right? It might not be the most tax optimized choice, but it sounds goofy, but like a life optimized choice. It's like, this is the whole reason for doing this stuff. You're wanting to turn all of this compensation and stuff into the life that you're wanting to lead, right? Whether it's something for yourself, whether it's for charity or anything like that, that it's like over all of this stuff is like what's actually important, right?
Yeah. Yeah. It's, I have so many anecdotes, I feel like, but two that are just popping out right now are, I had a colleague who basically said this, and this is compensation. At the end of the day,
Yep.
it's easy to think about restricted and non-qualified as compensation, but even ISOs, it's compensation for wages rendered, or,
Yeah.
or excuse me, services rendered.
For services
right?
rendered, yeah.
So, that's what it is, and you're going to pay ordinary income tax on it, and that's fine, right? But it's
Right.
compensation. You're choosing to leave it in stock at some point, but it's just compensation.
Right.
And now the obviously tail of that is, if you want to get long-term capital gains, you might be able to if you meet X, Y, and Z, right?
Right.
But at the end of the day, it's just compensation.
Right.
And then I heard somebody say the other day, actually, you get rich through the stock price, not through the tax savings, right? And
Yeah.
again, that's kind of a crude way to say it, but it's I think that the stock price is whatever you sell at, that's going to be more indicative of what you cash out to some degree
Right.
than potentially the tax
Right.
savings or optimization or whatever term you want to use for that.
Yeah. I like it. I like saying it that way versus that whole like tax tail wagging the dog thing.
Yeah, exactly. Well, but I've definitely used that. You've
Right.
used that too, right?
Yeah. Oh
Yeah.
yeah. I've used it. Like, don't get me wrong. I've definitely used that. But
Yeah.
that sounds better, right?
The other way hits the hammer a little harder, right?
Right. Right. Yep.
Yeah. But I think there's a lot of truth to it too. I mean, what's an ISO qualified sale going to get you? 15% dip spread maybe between highest ordinary income and long-term capital gain, and a lot of confusion. And don't get me wrong, like under the right circumstances, let's talk about it, let's understand it.
Yep.
But a volatile stock price can move your after-tax compensation up and down wildly.
Right.
So
Right.
that's going to be more of the impact in the long run potentially than the tax optimization.
Right. Yep. Yeah. And I guess
Yeah.
to like what's going on currently, it being the beginning of March 2022, that like people that I've worked with that for last year, it's like, hey, we're going to exercise and hang on. That the stock price has gone down to the point where it's like, well, I mean, it didn't end up working out from that perspective of like the tax savings got eaten up by the stock price going down. Right.
That had they sold last year is what you're saying, right?
Right.
Yeah.
Right.
Yeah. Yeah. And the whole point there is exercise ISOs at a lower spread, kind of potentially minimizing or mitigating AMT, right?
Right. Yep.
Yeah.
Yep.
So it's no answers, right? It's personal.
Right.
Is that what you said? It's personal.
Yeah. Yep. It's all personal. It's personal finance, right?
It's personal finance, right? So it's
Yeah.
yeah.
Okay. All right. Cool. So lastly, I always wrap up with getting into swimming in the crazy waters that is Reddit. And so I grabbed a question out of the Reddit personal finance sub, and I thought this was a pretty good one. And so it's someone saying that they are at a company and the company is expecting an IPO this year, and they have non-qualified stock options. And so basically they're asking the question of, would there be any benefits of exercising any of those now? And it says, if I plan to sell this year anyways, right? I'll open it up to you. I'll let you I'll let you start with it.
Yeah, and again, not specific advice, right? This
Right.
is not any specific advice. This is conceptual.
Yep.
So let's talk about what's happening there. You're going to exercise non-qualifieds, and that exercise, the spread is going to be ordinary income, subject to Medicare and Social Security, right? So you're going to pay ordinary income on the spread, and then in this example, it was we're going to sell this year anyways, right? We're going to sell this year anyway. So logic would tell us then that the fair market value at exercise to the final sales price would be a short-term capital gain, and short-term capital gain then would also likely be, ordinary income tax rates, right? Or short-term capital gain tax rate. So it's going to be a similar tax impact. So again, not exact, it's a little different, but is there a reason then to do it if the tax implication is going to be the same? I don't know, right? Again, I'm going to say personal, but I'm not sure that is the risk worth the reward. I'm not sure it is.
Right. Yep. Yeah, and the one thought that I have with this is, the kind of one of the beauties or one of the nice things about non-qualified stock options is the fact that, it's literally an option for you to, like, you can make that decision of when you actually want to realize that as income, right? And so you're not forced to do it at any certain particular time, and so you have the benefit of being able to watch, like, not put any of your money at risk and watch how your stock does, right? So that and you don't have to be pot committed, right? You can just kind of be like, yeah, I have this. It's just an option. It's a coupon to say I can buy this at a discount, but I'm not going to use it yet. I'm going to wait, and like, you can watch the stock go up and down, right? So it's a lot better in being able to control, like, how much income like, if you want to control how much income you realize in one particular year versus another one, right? So,
and it gets into issues of spread between strike price and fair market value. What's the final sales price? Leverage, right? To your point, kind of the fancy word for I get to control this for nothing is leverage, right? Stock options have leverage. So, what's the value of that? So again, taking a look at all those factors could impact the decision making you make with that non-qualified stock option.
Right.
And then to not go like way back in the weeds, but if you get non-qualified really early, you're a really, really early employee, then you can get into situations like 83B elections and other things that could be something you want to look at, right? So, but again, that's probably not what we're talking about today, but something that's out there, depending on where you are in the pre-IPO process.
Yeah, you just give me a really good idea for another live stream now. It's just all going to be, actually, I did do a live stream with Aaron Octi where we talked, we just kind of did the journey from a startup through IPO. And so, it kind of gets into that startup side of it of, this idea of 83B elections and things like that. But I think it's probably complicated enough that it could use its own show too.
Right. Yeah, it's definitely not something you see a ton of for obvious reasons, but if you have a client who's in that space, it could be something to consider, right?
Right. Yep.
Yeah, and then you can go on QSBS. You could do a ton, Mike. I know you could do it.
Oh man, it's
the wheels are spinning, right?
Yep. We actually, that live stream that I did with Aaron, that we did that, it was like an hour and a half or something like that. It was silly.
Oh my gosh.
Yep. It was crazy.
And what was that? That was on startups. You said startup to IPO.
Yeah, it was basically the private company journey, right? So from startup to going public, and so it's just whenever you're starting up, what the usual things, what kind of compensation you'll usually get. Yeah, we mentioned QSBS a little bit and all that stuff, right?
Yeah.
So I'll put a link on it in the notes of this one. So
yeah, share it out. That'd be good.
Yep. Okay. All right. Cool.
Well, hey, what kind of wisdom do you have? What kind of wisdom do you have for the IPO?
Just hey, the question that I posed you, right?
Yeah.
Yeah. So I would say kind of like what I said before of just understanding. Yeah. First, I do always lead with like, what do you actually care about? Like before we start because people will come and they'll already be in the weeds of the math and all that stuff. And it's like I tried to slow it down and be like, okay, what do you actually care about first, right? So talking about do you have a need for the money? What does everything else look like in your world as far as how concentrated you are? Like, does this IPO represent 30% of your world, or is it 98% of your world, right? And so if you're really concentrated that way, then there's you know, that can say, hey, maybe it's okay to take some of it out. And it's like you don't. And then also making that point of just because you're selling it and getting it out of your company doesn't mean you're just stuffing it under your mattress after that, right?
Yes.
That it can still work for you, but just not in such a concentrated way that it's tied to this one company that, by the way, you actually work at too, right?
Yeah.
Yeah. So there's definitely that part, and then also looking at how much more you have vesting later, right? Because you know all this stuff that we're talking about, it's you can take action on what you have vested. You know, if there's stuff that's still unvested, then that you still have to wait even past the lockup, past trading windows, and all that other kind of stuff. And so that's one
Yeah.
thing that I've found valuable for whenever I'm talking to people of, hey, even if you sell this now and the stock shoots up, you're still rooting for it to shoot up because you have a lot more, you know, options and RSUs and all that other kind of stuff that's going to be vesting, and you're going to participate in that way,
Yeah.
right? So
Yeah.
I think that's one way that helps frame it for people too. But yeah, and then yeah, just understanding the tax part of it again. Like the other way that I say it is that the taxes informs the decision, but it doesn't dictate the decision, and so
Yeah.
yeah, so that's better than the whole dog thing. I got that from somebody else on Twitter, I think, in wording it that way.
Yeah.
But yeah, so it's like it's knowing the tax consequences and stuff, but also just being, you know, and really I think with a lot of people from a tax perspective, the main thing that gives them heartburn is that they just don't know. Like it's like I don't know how much I'm going to be paying in taxes, and so it's just knowing
Yeah.
that it's like okay, yes, you will pay, you know, you're going to pay this percentage here because this is how much your income is and all that stuff, and even if it is a big fat number, you know, it helps to just know that it's like, okay, yes, you're going to pay this much in taxes, and then also be able to show this is how much you're actually going to be able to bring home and you can use in the ways that you're wanting to use it.
Yeah. Yeah. And you know, here's what you're going to pay, and here's how we're going to cover that, right? This is the
Right.
money that's going to
Right.
go to cover tax, right? Put
Right.
this over here, right? Not
Yeah.
yours. It's not yours, you know? And that part of it is really important for sure. But you're right. I think so many clients come in with a tax question, right? And it's way bigger than a tax question, right? It's
Right.
more than that. But framing it in light of RSUs that are coming in the future, because a lot of times, as you know, once these go public, okay, ISOs are done.
Right.
Maybe now you're just getting RSUs, right? So what
Right.
are RSUs? What does that mean? You know, and helping educate on that side of it too, plus all your unvested options if you have them.
Right.
Even if we talk cash out value too. I'm not sure if you've heard that, but hey, if you were to
Oh,
just sell
okay.
everything today, you know, what would you take home, right?
Okay.
Just
Yeah. Yeah.
yeah, and that's like a really interesting dialogue too to say, hey, if you cashed out, I don't know, pick your favorite number, $1 million after tax, you
Right.
know, how does that make you feel? You
Right.
know, would you go invest in your company again?
Right.
You know, and just it's an interesting dialogue.
Yeah. 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 It definitely makes for a lot of interesting conversations, for sure.
Yeah. Oh, cool.
Yep. All right, cool. Well, hey, I totally appreciate you agreeing to come on. I said that you agreed to slum it with me over here. Um,
I love it.
but
It's great to be here. Thanks for having me.
yeah, yep. So I guess yeah, just real quick, just for anybody like where could like if they want to learn more about you in the firm, then where should they go?
Yeah, so the best thing to do is Google, right? You could still Google Daniel Zajac. That's the easiest one. We pop up right away. The official site's Zajac Group, zajacgrp.com.
Yep.
Click on our insights or our blog. You can read. I'm coming up on 100 articles of equity comp. So all things equity comp, from really technical to, you know, more on the personal side too. So there's a ton of really good information, I think, right? Obviously, I think it's
Yeah.
good
Yeah.
information, but feel free to check it out. And the cool part is it's free, right? So
Yeah.
it's all there for you.
Yep. All right. Cool. Well, hey, I appreciate it, and for everybody else, appreciate you joining in, and I'll see you guys in a couple weeks. All right. See you.
Correct.